Stocks oscillate in a band after a sell-off in the US overnight over weak economic data. Metals and oil and gas gain, while utilities and consumer durables drag.
IndusInd Bank reports a strong performance in its core business, but credit quality concerns on its microloans and uncertainty over leadership continue. All of that keeps the street in check.
The Adani Enterprises stock sulks ahead of its 20,000 crore FPO as new shares will be offered at a discount to the current market price.
Persistent Systems gains on delivering stronger margins. Vedanta is up on winning the bid for Meenakshi Energy, and SAIL perks on analysts turning upbeat on its prospects.
Good afternoon, welcome to Halftime Report. I'm Sonal Bhutra and with me are Mangalam Malu and Ekta Batra. Hey guys, good afternoon. Well, it has been a volatile day so far. We did see sharp recovery from the lows. Again, that has been sold into. So for now, we are sitting with cuts of 42 points on the Nifty. The Bank Nifty is lower by around 141 points. That's the one which is a bigger underperformer today. The mid-cap index absolutely flat. But if we look at sectoral movers, it's only Nifty IT which is barely in the green. Across the board, there's selling that we are seeing. But of course, stock-specific moves is something that we continue to track. We have big voices coming in from Davos, big earnings as well. So that is the reaction that we are watching out for. Hey guys.
Hi Sonal, hi Mangalam. Yes, absolutely. And you know, it is a lot about stocks. While we do have a lot of cues to reckon with and we are moving closer towards the budget, towards the Fed meet, towards the RBI meet, as of now, we do have earnings to reckon with. So a lot of stocks in focus on account of that. But separately, just watch out for a couple of these stocks which are showing a lot in terms of turnover today. For example, Tata Steel, there was a bullish report which came in from CLSA a couple of days ago. So that continues in terms of a strong run. IndusInd Bank, Adani Enterprises, Persistent Systems, all of these stocks are in focus on account of earnings as well as possibly other pieces of news and top turnover stocks in today's trading session. Nifty results to watch out for in the next couple of days. We have HUL Asian Paints today, Reliance tomorrow, so important to mention that. And separately, we'll follow it up with ICICI Bank as well as Kotak on Saturday.
All right. Hi, guys. Just looking at a couple of individual stocks. CCL Products is the one which has actually spiked to the high point of trade. The company reported its results yesterday, and this morning there was the conference call as well. Maybe the street lights some of the commentary that came in from the management. So let's hear out from Chala Srisant himself. He's the managing director of CCL Products, joining in to discuss the quarter gone by and, more importantly, the prospects going ahead. Chala, always a pleasure speaking with you. Just a couple of things. One, the volume growth in the quarter was lower because your India plant was shut for 20 days. How much was that in terms of lost sales, if you could quantify that? And the second part is you've announced an investment of $50 million to set up another facility in Vietnam. So when does that come on stream? How do you fund this? And what does that mean for incremental revenues?
Yeah, so first, there's almost a 20% reduction that we have seen in volumes because of the plant shutdown. This was a planned shutdown which we have already announced last quarter itself. And we've also made it clear that our guidance for the year remains the same, the 20-25% volume growth, EBITDA growth, and all that still remains the same. Regarding the freeze-dried expansion in Vietnam, this will come online in FY 24-25, quarter 3. And we are doing a $50 million investment. Around $35 million will be in the form of debt, and the rest will be internal accruals. And this should add another additional approximately 350 crores per year as revenue from that additional facility.
Okay. Srishant, you are talking about 300 to 350 crore rupees in terms of additional revenues. Once all of this capacity expansion actually comes on board, what kind of market share are you looking at? And what will be the next plans for growth once it actually comes on board?
So right now, with this capacity coming online, we'll be at about 77,000 tons. That will be about 8% of the total market share. We're already the largest and our volumes are still growing. 3 years later, we're actually putting a lot of strategies in place for the growth for the 3 years after the current 3 years. We're focusing on our branded business, FMCG products, some brand acquisitions also is something which we are seriously considering. So there are a lot of options which are there on the table. We are going to seed the market for the next 3 years, and that will deliver the results after 3 years.
Okay. Just another quick question. As of FY22, your top 5 clients were around 22% of your sales or 26% of your sales. There was a strong amount of concentration in terms of the top 5 clients. That's better than FY21, where it was over 30-odd%. Where is it today, and are you planning to probably diversify your client base even further?
So when we talk about clients, most of the top clients are actually our partners in different territories, and they are in fact reselling to other customers whom we are developing with them. So it will not really give you a very clear picture if we are concentrating too much with certain clients or no. Our customer base is growing. Our number of customers is actually growing. The number of new brands coming on board is also growing, including supermarkets as well as brands. So our volumes are also increasing because of these new additions.
Our appetite with growth plans post the capacity expansion, and importantly your own FMCG vertical when you will launch it and grow that. What we'll request you to do, Chala, is to just hang in there. We take a short break, come back, continue our conversation with you. Stay tuned.
Welcome back. Well, let's continue our chat with the management of CCL Products. Mr. Srishant, thanks for holding on. You did mention that you are interested in terms of acquisitions. You haven't done any till now, and that would probably be in your B2C segment. Just want to understand what the opportunity would be, any kind of size that you're looking at, and anything that we could hear in this calendar year.
So, to be frank, it's a bit too early to say anything. We keep getting numerous offers from, let it be existing customers, from funds, analysts. So we have been evaluating, frankly, for quite some time, maybe almost 2 years now. Unfortunately, nothing panned out yet. But hopefully next time when we speak, there might be something. I'll keep you posted.
When we speak next time, we're waiting for, next time will probably most definitely be before the end of your quarterly results, or maybe during around that time. We'll talk about that. You're obviously not at liberty to speak about any acquisition that you're in discussion with right now. Two things. One, you had said that you will try to address newer geographies where coffee is being imported from outside and on which custom duties are being levied. And this happens once your entire expansion comes on stream. What countries are these? What's the opportunity there? That's one. And secondly, back home in India with the new FMCG vertical that you're, putting so much wind behind, what's the target there with regards to products, categories, revenue? Is there any goal that you have?
So first, as far as countries are concerned, we're looking at mostly Africa as well as Latin America. These are the areas where our volumes have been growing, and this is also where there's a lot of duty-related issues which are currently there. So we are exploring things over there. As far as the branded business is concerned, as of now, we already have a substantial market share. If you look at the overall bulk and private label business also that we are currently doing within India. We are already supplying to startups. We are already supplying to all the supermarkets, let it be in private label or in their own brand names. And all these volumes are also growing constantly. So our market share, overall coffee market share, is also increasing at a very, very healthy space. Now, branded business is already, we have about a 3% market share, and we are expecting that to further increase over the next couple of years as well.
To what?
To what will you take that number to, Mr. Srishant?
It's right now we are targeting a little less than about 200 crores in the current financial year. We're targeting maybe around 250 to 300 crores range for next financial year. And beyond that, it's a bit too early for us to comment right now. So our internal targets for 1 year ahead, it's reasonably fair to estimate.
Yes, take that point. Thank you so much for joining us and detailing Q3 numbers for us. That's the word coming in from CCL Products. The stock is in focus on the back of earnings. But for now, we'll take a short break. And as we do that, here is an important information for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list.
Welcome back. You're watching us here on Halftime Report. Let's talk about stocks which are in focus post their numbers. IndusInd Bank is one of them. Abhishek joins in to tell us more. Abhishek.
Well, Mangalam, records have galloped in Q3 numbers. However, it's a mixed set. So, ninth quarter, of operating profit growth of both YOY and quarter-on-quarter. This is led by the fact that, net interest margin is at 10-quarter high. So, return ratios are one of the best in last 3 years. The risk in balance sheet is reducing, as you can see, RWA to advances ratio at 15-quarter low. NII growth is the best in last 11 quarters on a YOY basis, coming in at 18.5%. Asset quality, one of the best in last 3 years, given the fact that, 2.06% gross NP ratio is the lowest in 8 quarters. And if you exclude one-off in Q2 or Q3 FY21, it's one of the best in last 21 quarters. However, the flip side in the result is the MFI portfolio, wherein the asset quality has deteriorated. In absolute value, the gross NPA has increased by 525 crore. This is largely led by the fact that MFI portfolio deteriorated. So disbursements were more than 8,900 crore in the quarter gone by in MFI portfolio. The book has increased only by 71 crores. PNL, both in terms of NI and PAT, it's a beat, and brokerages remain bullish. Target price ranging from as low as 1386 to as high as 1600 per share. Back to you.
Okay, all right, Abhishek, thanks very much for that. So the consistency, at least in terms of the performance for IndusInd, continues, and brokerages such as Morgan Stanley, in fact, have raised their target price on the stock post the numbers to over 1,500 rupees. But let's move on then. The other stock in focus is Adani Enterprises. The stock is under pressure today ahead of its 20,000 crore FPO, as new shares will be offered at a discount to the current market price. Vivek Iyer is following the story. He's here with more.
So the opening date of this particular FPO is on Jan 27th. It will run up till 31st of January, and the anchor investment date is on 25th of January. Now, what is interesting is the issue price band. The lower end of the price band is at 3,112, and the upper end is at 3,276, which implies a significant 9% discount to yesterday's closing price. Also, on top of that, the retail participants, that are people who will be investing less than 2 lakhs, are getting a further 64 rupees discount on this particular FPO. Now, what is it that the company is raising funds for? Green hydrogen, airports, and greenfield expressway projects. The company will invest over 10,000 crore from this particular FPO proceeds, and over 4,000 crores will be used to repay debt in their various subsidiaries.
Okay, Vivek, thank you so much for all those details. The stock is lower by 4% in trade, but the other stock which is in focus is Persistent Systems on the back of strong set of numbers. Reema is here with the analysis. Reema?
Thanks so much for that. So the top line growth for Persistent has actually come in slightly ahead of consensus expectation. Dollar revenue growth 3.4%, constant currency revenue growth of close to about 3.5%. And this is despite the company losing about 2 to 2.5% of its top line due to furloughs as well as holidays. That's what the management had to tell us in an interview. Margins have expanded by 80 basis points quarter on quarter versus expectations of flat margins. EBIT margins now stand at 15.4%. And the company told us that their aspiration is to improve margins from current levels by 200 to 300 basis points. Deal wins have been very steady. The pipeline is very strong. The deal wins in the current quarter stand at $239 million. The top client is a bit of an issue. The top client revenues declined by 12% quarter on quarter and down 43% on a year-on-year basis. But the company says this was a planned ramp down which began last year. But they believe the revenues from the top client have bottomed out and they expect a reversal in the next few quarters. The only worry is that the furloughs are likely to extend into the next quarter as well. So what the management told us is that in Q4, the furlough impact may be about 50 to 75 basis points. So that could be a worry or a trend that we would watch from the other companies as well. Back to you.
Okay. All right, Reema, thanks very much for that. So JPM's first cut on Persistent also indicated that there was definitely a positive surprise which came in terms of growth and margins, but maybe a little bit of trepidation with regards to the slowdown in the verticals. Time for a break now, but up next, Aditya Agarwal joins in to give us a technical check. Stay tuned.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. It's a good time to get a technical check on the markets. Aditya Agarwal, Head of Research and Investments at Invest4Edu, is joining us now. Aditya, good afternoon. Thank you so much for telling us. Tell us what are the charts suggesting as far as the Nifty and Nifty is concerned, and also quickly your tech picks as well.
Good afternoon. Thanks for the show. Clearly, we've entered into a consolidation phase, and within that consolidation, we are witnessing a volatility. So on the upside, Nifty faces resistance closer to about 18,260 to about 18,300. That is the upper end of the zone. The lower end of the zone is closer to about 17,800, 17,900. So every time market comes closer to the lower end of the zone, we are witnessing a bounce back. And as we inch closer to 18,200 to about 18,260, there's a bit of a profit booking that kicks in. So clearly that is what we're seeing today as well. And I guess this is likely to continue till budget, maybe volatility within the narrow range. For the day, maybe if Nifty starts to trade beyond 18,170, 18,200, it can inch closer towards 18,300 to about 18,270, which is again in the hurdle zone. Same holds true for Bank Nifty as well. On the upside, 42,500, 42,600 is the hurdle, and on the downside, 42,200 or 42,100 is the support. So maybe traders should look at this range and play the range, lower end buy and upper end of the range, maybe book out profits. Having said that, so there are a few pockets which are outperforming. So banks are something, select banks are outperforming. So HDFC Bank is something which definitely tops the chart and the pick. So one can go ahead and buy at current levels, look for a target of 1700 on the upside with a stop loss at 1615 on the downside. It's broken out from a bullish flag pattern. The second stock recommendation is SBI Life. Now, if you take a look at the movement of the stock, overall, it has been an outperformer, and post-consolidation, it is showing good up move again on good volumes. So traders can definitely latch on to the stock at current levels. Look for a target of 1400 on the upside with a stop loss of 1270 on the downside.
Aditya, thanks a lot for that. On that note, we'll take a short break, come back, get you more on the markets and individual stocks. Stay tuned.
Welcome back. You're watching our continuing coverage here from Davos 2023. I'm Shireen Bhan, and I'm joined now by Infosys' Salil Parikh. Salil, many thanks for joining us here on CNBC-TV18. You know, Indian tech closed the last quarter on a strong footing, better than what the street was expecting. But overnight, the headline here has been about the layoffs, Microsoft laying off people. Is there any indication that you're getting that this is now going to start to impact Indian tech as well? Are we on the cusp of starting to see layoffs, for instance, as far as Indian tech is concerned?
So thanks, Shireen, for having me here. Wonderful to be back here with you. For Infosys, as you saw last quarter, we had good growth. We, in fact, increased our guidance. We're seeing two drivers for growth. One is the continuing work on digital and cloud, and I'll come to that. The second is much more on cost, efficiency, and automation. So we're seeing a real thrust on that as well. We believe we are well positioned for that. So from our perspective, we think the growth will continue. On the digital and cloud, there are some industries where we see some impact. For example, in financial services, in mortgages or investment banking, a little bit in retail, somewhere in the high-tech sector and so on. But for our own business and for both of these drivers, we see some good traction going ahead.
So you don't anticipate that we are going to be faced with the possibility of laying people off as far as India is concerned in the tech space?
For India, I don't know, but for Infosys, we are looking in good shape right now to drive this growth. The cost drivers, the automation, the efficiency, we see more and more traction to it. So we believe that that is going to give us good traction as we look at the pipeline.
You know, of course, as I said, commentary was very strong and positive at the end of the quarter. What are you hearing from CEOs here? The mood seems to be better than people were expecting and anticipating. But do you believe that that's just the Davos sort of consensus, or is that for real?
Well, you're absolutely right, Shireen. I think I've had several meetings here over the past few days, and the sense I get is, in general, people feel positive. They feel positive, especially given that they think the worst of the inflation in that sense is behind them. This is more the US or the European client executives we met. And then they see that over time, potentially some of the demand will come back. Underlying that, the view is the consumer sentiment is still positive in many parts of the world. So overall, as I reflect back, there seems to be positivity from the sessions here.
Well, that's good to hear, but let's see how that plays out. There have always been questions about the Davos consensus, but let me get you to comment on what you're seeing as far as the deal pipeline is concerned. Very strong for you. Is there any expectation of any kind of moderation in any specific areas or any specific geographies at this point in time?
So there, as you mentioned, the deal pipeline is still strong. And in fact, our large deals in the last quarter was 3.3 billion. We still have a very good pipeline for that. In fact, it's bigger than what it was 12 months ago. So there we feel good. Again, more and more coming into cost and automation, and some in digital transformation. The areas where we see some of the focus not so much on digital is the ones I mentioned: financial services, banking or mortgages and so on. In geography, the economic talk is more of a concern in Europe. However, we had much stronger growth in Europe last quarter. We have had a good foundation over the last 18 months. We think that will continue, but that's the commentary here more in some of the European countries.
When we last met here in May, Salil, you had talked about how you want to bet big on cloud, and inorganic opportunities was something that you were scouting for as well. Since then, I think you did one deal in July. What's the appetite now as far as acquisitions are concerned, and specifically to do with both these areas that you're betting big on, which is digital as well as cloud?
So there, in fact, our view is we are even more ready than we were in May to look at something in terms of acquisitions. As you've seen, the valuations are much more reasonable now. Both areas, on digital and of course on cost and automation, there are opportunities, but we don't know how it will play out in terms of the timeline, but we are actively looking.
Anything that is imminent at this point in time, or?
So there, as always, difficult to say anything about it, but there are discussions, but nothing we can talk about.
But this is definitely a better time to go shopping, you think?
Yeah, this is definitely, for us, a better time to look. I think there's more realism in what the expectations are. The view is more going to be how can we look at integration and cultural fit.
In terms of capabilities, Salil, where do you believe you need to maybe beef up capabilities at this point in time? And what are you also seeing in conversations, especially now with AI and the use of AI through ChatGPT becoming sort of real and up close, perhaps for the very first time?
So there,
at least as far as a regular consumer is concerned.
No, absolutely. I think generative AI, as this sort of category is called, is moving at rapid pace. So the advances are very positive. We've been fortunate to be associated with it for some years. We've been using generative AI in our automation quite a bit. We see productivity gains between 5% and 20% from some of the technologies we've used with client work today. So we see a good potential for this.
Is this going to be something that you intend to double down on?
We are absolutely, we've been quite focused on it. We will continue to do more with it. We need to make sure, so there are things, for example, which also help in making programming more productive. So for example, things like Copilot and all. So we are working with a set of these tools. We've been quite intense with it for about 2 or 3 years already in really trying that out. and now more and more is coming to good.
You know, you were with Satya in Mumbai, and I was watching the two of you speak about what the year ahead looks like, or what the next 5 years looks like as far as tech is concerned. And while there will be short-term hiccups, and I think that was something that Satya acknowledged as well, he said that the secular run for tech and digital transformation continues. So from a 5-year perspective, where do you believe Infosys is poised today? A lot of the work that you wanted to get done has now been done already. What does the roadmap for the future, not just the quarter, look like from here on?
You're absolutely right. I think the 5-year or the longer term outlook for tech is extremely positive. The world around is moving to digital, and we are literally in the early stages. We don't think more than 20% of that work is actually done if you look at the global enterprises. Once we get down to it, our capability, so you know about our Cobalt capability, but we have many such capabilities that are helping clients drive that, and our partnerships with large cloud players. So we believe there's huge traction and huge optimism for the next 5 years.
Okay. I also want to understand from you where you are in the journey of trying to get people back to work, because everyone has experimented with hybrid, will continue to experiment with some kind of hybrid, but the message seems loud and clear, at least conversations that I've had with tech CEOs, that you need to get people back. What's going on that front?
So for us, we've kept a view which has been extremely focused on employees. We've had a very flexible approach, and it's worked really well. Every week we've been seeing more and more people back on campuses in India and in offices around the world, and we will continue with that. With that, we are seeing, I was at one of our food courts 3 or 4 weeks ago, just before the December break, and the sentiment I heard from our employees was they want to come back because they want to connect with the teams. They also want the flexibility, and so we are making sure that we do everything that supports them.
So let me end by asking you, Salil, what would you identify, in addition to everything that we've already spoken of, as the growth drivers, the next growth enablers as far as the Infosys story is concerned?
So for Infosys, yes, we've talked a lot about cloud, but it's really about doing what we've done with our clients, which is remaining relevant. The things will keep changing, and one Infosys, which is all of our teams working really jointly for what clients want. And that's, to me, the big change. If we can keep focused on that, ensure we don't become complacent, we have a good runway ahead.
And the one Infosys map, are you done with putting that together, or is there more work needed there?
I think we've got a nice foundation for it, but there's always more work, because there's always things we can do better for the client. More services, making sure we're thinking of clients first. So we will continue on that, but the foundation is in good place.
How much of that is also going to involve nearshoring?
We've always had, in the last several years, a big approach to recruit in markets all around the world. Last financial year, we did about 80,000 college grads, of which 75,000 in India, but 5,000 all around the world. We are expanding in many geographies, so of course in the US, but in Germany, in the UK, here in Switzerland, in Canada and Australia. So that continues quite well.
Salil, always a pleasure. Thanks very much for joining us here in Davos on CNBC-TV18. Appreciate your time.
Thanks, Rina.
Well, we are going to take a break, but the conversations continue here in Davos. Don't go anywhere. We're back in a minute with a lot more.
Welcome back. Well, sluggish day, and the bank Nifty is now down around 0.4%. We have the Nifty as well, which is down over 50 odd points. We have a lot of stocks which are losing. The advance decline ratio currently stands at around a little close to 1,600 stocks advancing to around over 1,800 stocks declining. So that's where it stands on the Bombay Stock Exchange. That's what's taking place on the equity market. Let's go over to Manisha Gupta, who joins in, our commodities editor, to apprise us of what she's tracking in the commodities space this morning.
Ekta, thank you so much for that. I'm looking at the crude oil prices because we are headed for a weekly gain perhaps, but we have seen a sharp decline or a profit taking in the overnight markets there. So the New York session did see a high of $88 a barrel almost, and the WTI was trading at $82 a barrel at one point in time, but $4 shaved off from those kind of highs at this point in time. Navneet Damani is Senior VP Head Commodities at Motilal Oswal, and he joins us to talk further about that. Navneet, hi, good to have you. It's a choppy market, and while, on one side it has been about China reopening, and that seems to have been factored into the markets, it clearly has been about the weak economic data that we have seen come in from China, followed by US, and then the crude inventories build up in US. All of that seems to be putting pressure.
Well, Mecha, it started on a very positive note, and the market has been consolidating between $75 and $82 for the WTI for maybe more than a month now. And yesterday we saw it hitting the highest level of 82 and a half for the last, say, probably 60 trading days. But since then, as you rightly pointed, market has given too much heat to China reopening and zero COVID policy. And to top it up, data has not been very rosy. Now, Chinese markets are headed towards a shutdown once again from 23rd to 27th. They are headed for a Lunar New Year holiday. And post that, historically, we've seen that once market reopens post Lunar New Year, there is a change in strategy or change in shift from China. Then that is what exactly could be anticipated this time as well. Along with that, on the 4th of February, we have sanctions which could be levied on Russia, and a meeting is due there. So a couple of major events which could be a game changer for crude oil prices are headed. So I do not see any directional clarity coming into the prices anytime soon. Maybe this range of 82, 83 on the upside for WTI and 75 on the lower side for WTI could continue, so probably for the next couple of weeks or so.
All right. You've talked about a quarter or so, but what's your sense going forward? Because most of the banks and brokerages believe that the 3-digit number is coming quite soon, and that could be by the end of the second quarter itself. Are you bullish when we step into that one?
Well, we have a similar stance, and we pretty much expect that $95 is pretty much on cards, and maybe market tends towards $100 also possibility. But before that, we expect some cool off or some correction or whatever we have seen in the last, say, probably 20-25 trading sessions from lows of 72 to highs of 82. So about 5, 7, 10% correction is warranted in most of the commodities which have run up very sharply, be it metals or be it energy prices. Natural gas is behaving a little erratic, so we skip that. But crude and base metals are probably likely candidates for some cool off in the near future.
All right, a cool off of 7 to 10% would be quite a bit. But would those be buying opportunities then, or you think the markets will start consolidating at lower levels?
I think first quarter is largely for consolidation and a range-bound move. And as we approach the second quarter, we'll have better clarity over the recessionary fear which is going around, or probably how sharply China reopens and what are the big bang announcements which are coming up from China, which could provide some impetus to the slowing economy. If that does not happen, then the second quarter is also probably a sluggish quarter. But most likelihood is that China could announce some big bang announcement which could pent up demand for crude oil as well as most of the other commodities in the second quarter, where you can see probably 90-95 as an approachable level.
I'll stick to crude for time being. And, OPEC has said that they are looking at 2.2 million barrels per day of a global demand in 2023. IEA said that they're looking at a record average daily demand coming in for 2023 at some point in time. With such bullish cues and sense of demand, what's your sense? When do you see that happen? And is that what will lead to a 3-digit number?
Well, it is most likely going to start from the second quarter, and that has to be followed from some good announcement from China, because of the entire crude oil story, 50% weightage comes from China reopening, and 50% could be the other factors which could be driving. So if at all both the two factors do not combine together, the 3-digit number looks to be a little far-fetched. But most likelihood is that we will see those numbers coming in as we approach the third and fourth quarter of 2023.
Point taken. I have one final question, and this is on metal. Since you mentioned on that 7 to 10% of a decline is what we could see for many of these non-ferrous metals as well. Any metal in particular where you see more bearishness than the other? Because we are looking at strong fundamentals across board. Inventories are on multi-year highs. Do you think that could be a supportive factor?
Well, inventories are not suddenly in the declining mode. They have been declining for the last 6 months. But what has happened is China's zero COVID policy and some speculative interest has given about 12 to 15% rally in most of the metals in the last probably 30 trading sessions. And that's pretty much a surprise, because this kind of demand is not there in the store at the moment. As I mentioned, that second quarter is going to be the game changer. And just like 2022, 2023 also started on a very positive note. But will it hold or not is the question. My bet is that we will see some cool off, some consolidation before any reasonable upside from here on. Largely, whatever price possible upside was due in, say, something like zinc or copper is factored in, and some cool off is warranted.
Okay, Navneet, Manisha, thank you so much for joining us and taking us through that discussion. That's all about the commodity markets. For our own markets, consumption stocks, they have come under pressure. HUL ahead of numbers is at the day's low. So we'll track all the market action for you. But for now, we'll take your leave on this edition of Halftime Report. Business Lunch comes up next.